I want to begin with a number. Not a number I created, but one published this week by a serious institutional analyst that immediately caught the attention of the entire precious metals community. $3,147 per ounce of silver. Before you dismiss that figure as unrealistic or sensational, give me a moment. Over the past several days, I carefully reviewed the mathematics behind that projection. Every ratio, every historical comparison, and every assumption supporting it. What I found was striking. Even after aggressively reducing the inputs to the most conservative and restrained versions possible, the calculations still pointed to a silver price that should force any serious investor to reconsider their positioning. Today, we are not focusing on the headline figure itself, but on the structural framework beneath it. Because mathematics does not respond to emotion, and what the math suggests about silver's long-term trajectory, even under cautious assumptions, is something mainstream financial media refuses to address. Today is Sunday, February 22nd, 2026. Markets are closed, but Friday, February 20th, delivered a closing snapshot that deserves careful attention. Silver settled at $84.52 bid, after trading between $77.39 and $84.85 for the week, a 7.77% gain. Gold closed at $515.90 bid, with a weekly range of $4,180.90 to $5,018.70, marking a 2.22% increase. These numbers are important not because they are dramatic, but because they confirm a deeper structural shift underway. Once you understand the three ratios we are about to examine, those closing prices will look very different by the end of this discussion. Most participants are currently watching silver's price action and reacting to weekly percentage moves. They celebrate green candles and short-term momentum, while overlooking the underlying architecture driving the market. The story is not $84 silver. The real story is the gap, the distance between today's price and where multiple independent historical ratios suggest it could be. We are looking at three separate calculations, built on three distinct inputs and methodologies, all pointing in the same direction. When you understand how these ratios converge, $84 no longer appears extreme. It appears early. That gap is where institutional capital positions quietly, while retail investors focus on short-term price fluctuations. Silver remains significantly mispriced relative to the debt realities embedded within the financial system. To understand silver's potential trajectory, we must begin with the foundational relationship between U.S. government debt and gold. This is the central pillar of the entire thesis. During World War II, the United States carried enormous federal debt. However, at the peak of that expansion, approximately 51% of federal debt was backed by gold reserves held in U.S. vaults. In practical terms, for every dollar owed, roughly 50 cents in gold stood behind it. That backing ratio contributed to the structural credibility of the dollar during one of the most expensive military conflicts in history. Fast forward to today. The United States still holds 261.5 million ounces of gold in reserve. The gold remains, the vaults remain. What has changed is the debt. That same gold now backs approximately 3% of total federal obligations. The decline from 51% to 3% did not occur because gold disappeared. It occurred because debt expanded exponentially, while gold holdings remained relatively static. That widening gap between reserves and liabilities is why some credible analysts now publish gold revaluation scenarios as high as $75,000 per ounce based purely on arithmetic. Here is the calculation. If U.S. gold reserves were revalued to cover 51% of today's federal debt, matching the World War II ratio, the required total gold valuation would approach $20 trillion. Dividing $20 trillion by 261.5 million ounces results in a price near $75,000 per ounce of gold. Applying a historical gold-to-silver ratio of 19:1, which has precedent in recorded market history, produces a silver price of approximately $3,147. The arithmetic itself is straightforward and internally consistent. The real debate is not whether the math works, it is whether the assumptions are realistic. This is where the discussion becomes more grounded. If you reduce the backing ratio from 51% to 25%, gold would still need to reach roughly $37,000 per ounce. If you use 18%, a level observed in 1980, gold still requires about $26,000. Even at a modest 10% backing level, gold would need to trade near $15,000 per ounce, roughly triple current levels. These are not extreme assumptions. They are scaled-down versions of historical precedents. Now consider a second independent framework. When comparing total U.S. gold reserves to the monetary base, that ratio peaked near 140% in 1980. Applying that same 140% coverage ratio to today's monetary base implies gold prices around $28,000 per ounce. This is a different input and a different methodology, yet it leads to a similar directional implication. There is no scenario within this framework where gold appears fairly valued at $5,000. The only question is how much of the current gap closes during this cycle. This brings us to the second major ratio, the Dow Jones Industrial Average priced in ounces of gold. When this ratio is elevated, equities are expensive relative to gold. When it compresses, gold outperforms stocks. Over the past century, the pattern has been remarkably consistent. The ratio peaked in 1929 before collapsing into 1933. It peaked again in 1966 before falling into 1980. It reached a record high of 44.8 in 1999 and has been trending lower over the long term since then. Today, the Dow-to-gold ratio sits near 9.85. That number matters not in isolation, but in historical context. In 1973, just before gold entered its strongest modern bull market, the ratio hovered near 10. It subsequently fell to 1 by 1980. During that period, gold rose from approximately $180 to $850, a 4.5-fold increase, while the Dow stagnated for nearly a decade. The compression occurred not solely because equities collapsed, but because gold repriced relative to stocks. The framework under consideration targets a ratio of 2.5, not the extreme of 1 seen in 1980, but a midpoint of historical compression. If the Dow remains near 49,500 and the ratio falls to 2.5, gold would price around $19,800 per ounce. Even under more conservative scenarios, the implications remain substantial. If the ratio declines only to 5, gold approaches $9,900. If it falls to 3.5, gold reaches approximately $14,100. Different assumptions continue to point toward materially higher gold prices. This matters for silver because silver historically outperforms gold during periods of ratio compression. In every major precious metals bull market over the last century, silver has accelerated faster than gold once momentum builds. This is not coincidence. It reflects structural capital flows during periods when debt dynamics lose credibility. Capital moves toward assets perceived as outside the financial system. It occurred in 1933. It occurred in 1980. And the closing prices we saw on Friday suggest the early stages of a similar structural shift may be underway. Now we need to address the 2011 comparison because critics often argue that silver already experienced its breakout cycle and failed to sustain it. In 2011, silver briefly touched $49 before collapsing sharply. Many point to that spike as proof that extreme upside projections are unrealistic. But what is frequently ignored is the structural backdrop. In 2011, U.S. federal debt was approximately $14 trillion. Today, it is exponentially higher. The monetary base, liquidity injections, and global sovereign debt levels are not remotely comparable. The scale of the system has changed. When the denominator expands at this magnitude, historical price ceilings lose relevance. The environment silver faces today is not a repeat of 2011. It is a structurally larger debt regime with far greater systemic leverage. This brings us directly to the gold-to-silver ratio. Historically, during precious metals bull markets, the ratio compresses aggressively. In 1980, it fell near 15-1. In earlier monetary periods, it traded closer to 16-1 for extended stretches. Even during the 2011 cycle, the ratio compressed to roughly 31-1 before the rally ended. Today, despite silver's recent strength, the ratio remains historically elevated relative to prior cycle extremes. That gap is critical because silver tends to outperform gold when capital rotates aggressively into hard assets. Let's apply conservative projections. If gold were to reach $15,000 per ounce, the reduced 10% debt backing scenario discussed earlier, and the gold-to-silver ratio compressed only to 35-1, silver would price near $428. That is not an extreme ratio. It is still well above historic compression levels. If gold reached $19,800 under the Dow-to-gold 2.5 scenario and the ratio compressed to 35-1, silver approaches $566. Again, not based on a 15-1 extreme, but a moderated compression. If gold advanced toward $28,000 under the monetary base framework and the ratio fell to 35-1, silver would trade near $800. These projections are derived from conservative ratio assumptions layered onto already scaled-down gold targets. Now let's address the bear case. The primary counterargument is supply. Critics argue that silver is not rare enough to justify exponential repricing, and that industrial production can expand to meet demand. However, this argument overlooks two realities. First, a significant percentage of silver supply is produced as a byproduct of mining for other metals such as copper, zinc, and lead. That means silver production is not purely demand-driven, it is dependent on base metal extraction cycles. Second, industrial consumption, particularly in solar technology, electronics, and emerging energy infrastructure, continues to absorb large quantities of annual output. When structural deficits emerge, they are not easily resolved by simply increasing production. Another argument centers on monetary relevance. Some suggest that silver no longer functions as a monetary asset in the modern financial system. Yet during periods of monetary stress, capital historically rotates not only into gold, but also into silver, especially when affordability becomes a factor for retail participants. Silver's dual role, industrial and monetary, amplifies volatility during expansionary phases. It is precisely that hybrid function which creates outsized upside during periods of liquidity migration. We also need to consider the physical market. Over the past several years, recurring reports have highlighted drawdowns in exchange inventories and persistent delivery tightness. Vehicles such as SLV have experienced inventory fluctuations that reflect shifting physical flows. While paper markets can influence short-term pricing, sustained physical deficits eventually exert pressure that cannot be ignored indefinitely. When available above-ground supply tightens, price discovery becomes increasingly unstable. In addition, silver's designation in multiple jurisdictions as a critical mineral introduces a strategic dimension. As governments prioritize supply chain security for renewable energy and advanced manufacturing, silver's industrial relevance strengthens. Policy recognition of critical mineral status does not guarantee immediate price escalation, but it reinforces long-term structural demand. Time horizon matters. None of these projections require overnight repricing. Historical ratio compressions have unfolded over multi-year cycles. If this cycle were to extend over 5 to 7 years, gradual compression combined with persistent debt expansion could produce significant cumulative effects. Debt continues to grow at a compounding rate. Monetary responses to economic slowdowns typically involve additional liquidity. Each expansion phase increases the baseline from which the next repricing occurs. This brings us back to the broader conclusion. The extreme $3,140 silver figure is not presented as a guaranteed outcome. It is a mathematical extension of specific historical ratios applied to today's debt structure. When those inputs are aggressively reduced, the resulting projections still point toward materially higher prices than current levels. Whether silver reaches $428, $566, $792, or beyond depends on the degree of ratio compression and the magnitude of gold's repricing. But across every conservative framework tested, the direction remains consistent. Exponential debt growth combined with finite hard asset supply creates tension within any monetary system. That tension does not resolve quietly. It resolves through repricing, restructuring, or policy intervention. Silver sits at the intersection of industrial necessity and monetary history. If gold continues to revalue against expanding debt, silver historically accelerates during the later stages of that move. The key takeaway is not a specific number. It is the structural imbalance. When multiple independent ratios, debt to gold, monetary base coverage, and Dow-to-gold compression all suggest higher equilibrium levels, ignoring the signal becomes a strategic decision. Friday's close at $84 may ultimately be remembered not as a peak, but as an early waypoint within a much larger recalibration cycle.